recording, right? Just in case some of you want to watch a replay, you can request from us. Okay, if you're invited by your advisor, you can just request the replay from an advisor. We don't mass send to everyone, okay, but if you request, we don't mind share with you the recording, right? But more important is to ask more questions because we are here to answer your query, right? Okay, so let me start the sharing. Okay, and let me start with introduce myself first. Okay, I'm your speaker for today. I'm Louis. All right. You can just Google my name, Louis Kueh. You can find many of my article online. Straits Time, Business Time, right, or even our own website, okay, or Facebook. Okay, you can see all our online presence. Okay, so I'm a founder of Holistic Wealth Planners. Okay, which is the hosted today host, right? I'm also a co-founder of Dr. Wealth. Okay, and I'm in Philips Security as a senior financial services director. Right, so these are some of the credentials I have. Okay, I mean at least you know you are listening to lah. Right. And of course, why we are doing this kind of sharing is because we aim to be the go-to brand for financial planning. Okay, next year, okay, we are launching more initiative. You'll probably see us physical branch as well. Okay, so that's our plan for next year, right? Holistic planners. Okay, we want to be present physically as well and not just online. Right. Yeah. So our approach, of course, is to share more holistic planning. Okay, so if you need any help about financial planning, you can always go to HWP. Okay, so that's our vision. And this is our team. Currently, we have expanded quite a fair bit. Uh, right now, we have 50 advisors. Okay, 50 advisors, and collectively, we are servicing more than 5 million in asset, servicing more than 28,000 clients. Right, for young working adults to retiree. Okay, we serve all different kind of individual. Okay, that's why regardless of which stage of life you're in, you can always approach us to do holistic planning. Right, and we provide full range of services. Okay, from insurance to investment and even in estate planning. Like last month, we completed our LPA seminar. Right, I think some of you actually attended the physical seminar, and the feedback was very useful. Right, we are going to launch more this kind of seminar next year. Right, so reach out to us, follow our page. Okay, that is how you can get to know more about our services. Yeah, so we are more than just an FA firm. Okay, we have smart park account where you can park your excess cash with us to get excess return. Okay, of course, right now interest rate has been dropping. You probably can't find a lot of good saving account or even parking account. All right, and to be honest, this is a temporary parking lah. You should make use of idling cash to make better return. Right, so we do provide wealth enhancer. Okay, such as there are some saving plan which are quite popular right now because we have been receiving a lot of people come to us say, hey, Louis, I have a T-bill matured this year or fixed D matured this year. I don't know where to park my money, right? So reach out to the advisor that invite to this webinar. We have many solutions that can help you to get a better return, right? And also protection. It's also a good time to review your total insurance coverage, okay? Because year end usually you probably have more time, right? Redo into your financial plan. Okay, make sure you are well covered, all right, and optimize your coverage because nowadays there are many ways to enhance your coverage and probably optimize your premium, right? So these are things that we help as well, right? And of course, holistic planning, that's always something that we advocate. Tax planning, okay, year end, you should start to prepare for this because by end of this year, you should do some top up if you want to for CPF and SRS. Okay, but don't do that first. Okay, go through follow this webinar. Right, speak to your advisor. Okay, before you do any top up. Okay, because most of these actions are irreversible. Right. And of course, we provide a lot of educational content on our website and social media platform. Right. Yeah. So we are using Philip as a platform. We can provide more than stock and share. Okay, so all these are the services that we can provide as a team. Right, and we have partner as well. Okay, we are a platform. We carry 40,000 solution. Right, so these are our partners, and these are not all. There are more than this. Right, just to show that we are a platform that work with different kind of partners, not just tied to any particular company. Right, and these are our social media pages that you can follow lah. Okay, or you can just Google Holistic Wealth Planner. Okay, that will lead you to some of our online presence. And we have our website as well, and our logo is copyright. Okay, so if you see HWP, must be from Holistic Wealth Planner. Okay, cannot be somebody else because this is a copyright within HWP. All right, so enough introduction. Okay, so now is the topics that we want to share. Okay, I have 1.5 hours to talk about CPF and SRS. CPF, I'll try to take longer because it's a bit confusing and you probably have a lot of questions, right? So I'll spend about 1 hour on CPF topics and I'll spend about 20 to 30 minutes talk about SRS. Okay, and I hope to receive more questions from you so that I don't just, read from the slide, right? Because webinar style, I literally just look at a screen and just talk, right? I can just ignore what you write, but try to have some question, okay, so that we have some conversation and not just reading from a slide, right? Yeah. Okay, so it's not the first time we do this kind of webinar. Okay, last year or actually beginning of this year we did a face-to-face seminar as well, talk about CPF, right? Because if you recall, early this year, CPF SA account closed, right, for those age above 55. Although it has been coming near to a year, there are still a lot of people ask me, hey, what should I do with this? Okay, how will it impact me, right, when SA account is closed, right? Still a lot of questions, right? So I thought year end is a good time to revisit this. Okay, and of course, SRS will help you to reduce our income tax, but you need to watch out what are the catch. Okay, so let's start with CPF first. All right. For sure, if you're Singaporean or PR, you sure have CPF. Okay, it's just how much and how you contribute, right? So you need to understand. Hopefully, all okay. If not, most of the important information you should know, right? Because every month you're contributing, you need to know what is this and how you can get back the money. All right. Yeah. So basic first. Okay, I'll start with this one you must follow closely because it can be quite complex. Okay, I'll go with a very slow pace at the beginning to ensure all of you are at the same page. Okay, on the same page. All right. So CPF always come in these four accounts, right? OA, SA, MA, and RA. Right. If you are below 55, you don't see RA. You only have OA, SA, and MA. Okay. Yeah. So you can't adjust the proportion because there's a standard proportion on OA, SA, MA based on your age, right? This one you can just Google your CPF board actually have a standard allocation rate for each account, right? And of course, OA technically is more flexible. You can actually use it for insurance, some insurance, okay, of course, for your house, down payment, installment, investment, education, you can use OA. Okay, SA pretty much limited to more into retirement, right? More into retirement, right? And of course, MA is even more limited to just insurance and hospital expenses kind of usage, right? And RA definitely is more for retirement, right? Yeah. So, I mean, when you contribute, it will go to OA, SA, MA. That one you cannot do anything. Okay. But what happens is when you reach age 55, okay, this is an important age, all right? CPF board will send you a letter or email say that you reach 55. There are some changes to your CPF account, right? And what are the things that will happen? First thing, they will determine what is your minimum sum. Okay, minimum sum for this year 2025 is 213,000, right? So CPF board will ask you to set aside this amount from SA, all right, to create an account called RA. Okay, take the money from SA, put into RA. Okay, if SA is not sufficient, they pull from OA and put into RA. Okay, to hit this minimum sum. Okay, so that is the default arrangement. CPF will take out money from SA to RA, and then CPF board will take OA to RA to meet your minimum sum. Okay, if you don't do anything, this is a default arrangement, right? So what is this minimum sum? Okay, technically they are locking in this amount, okay, but they'll pay it to you in the future, okay, through a scheme called CPF Life, right? I'll come to CPF Life, which technically is can be quite confusing, right? So if you look at it, if you are someone that say, I want to retire from 55, I want to take out money from CPF at 55, you can, okay, only if you set aside this amount in RA. Okay, if your OA and SA combined balance less than minimum sum, technically you can't withdraw anything from at age 55. Okay, I mean, if you read closer, actually you can withdraw 5,000 only lah. Okay, if you have total amount less than minimum sum. Okay, so that is a basic structure. Okay, I know Some of you may not reach 55 now, all right, probably 10, 20 years later, right? But you need to know what is the so-called ultimate outcome on how to get back the money now, right? Yeah. So minimum sum, that is the first thing you need to understand. CPF retirement sum based on this year is 213,000. Okay. Annual stated that it will increase by about 3% per year. So next year, minimum sum will be 220,000. Okay. So like for me, I'm now 39. All right. 16 years later, my minimum sum probably about 300,000, 400,000. I need to lock in 300,000, 400,000 in my RA. Okay. Before I can take any money from CPF account. Right. Yeah. So that's a full retirement sum. Okay. And also there's a basic retirement sum where you can park 50% of full retirement sum. Okay, 50% of full retirement sum we call basic retirement sum. Okay, I'll come to this later. Or you can even put enhanced. Okay, enhanced actually increase to 4 times. Okay, 4 times BRS. Right? Yeah. So in this case, this year you can park aside 426,000 in RA if you want to. Okay. So the biggest question is, should you park so much in RA? Okay, what are the pros and cons? Okay, I'll go into detail in the subsequent in the next few slides because it can be quite confusing. Okay, so you need to answer all these basic. Yeah. So the next thing is about CPF Life. Okay, so ultimately whether you lock in 213,000 or you lock in 426,000 or you lock in the lowest, which is 106,000, you need to know how they are going to pay out to you. Okay, they'll return the money to you for sure. It still belongs to you. Okay, but when they return to you, it's through CPF Life. All right, and this is the confusing part. Okay, yeah. So what is CPF Life? Okay, it's an annuity plan, meaning they pay you for as long as you live. Okay, when you're living, every year you receive every month you receive payout from CPF Life, right? And you need to use a RA to join CPF Life. Okay, whether it's 213,000 or 426,000 or anything in between, you can park anything in between to join CPF Life. Okay, so this amount you lock in at 55, all right, they pay out to you from 65 on monthly basis. Okay, but there's an important things that a lot of people are asking. All right, CPF Life, what is the return? What is the interest? We all know OA 2.5%, SA 4%, or probably 4.04, 4.08, sometimes a bit different, right? Yeah, we all know, okay, OA quite straightforward, 2.5, SA 4%. But what about CPF Life? What is the interest? Okay, and whether interest go to you directly? Okay, the answer is no, right? Interest earned from CPF Life are actually pooled together, all right? Yeah, with other CPF member. Okay, so this is a confusing part. Okay, later on I have more detailed kind of explanation on this. Okay, but just take note, CPF Life do earn interest. It's just an interest, don't credit to you directly. It will credit to a pool, right, to support you for longer payout. Okay, so that one I'll come to that. Okay, you follow. Make sure you follow every single slide because it will be more and more complex. Yeah. So the next thing is, okay, so when CPF pay to you, okay, from 65, you can choose how you want to receive a payout. There are 3 possible plans you can choose: escalating, standard, or basic. Okay. If you don't choose, CPF board will choose for you, which is standard. Okay, this is a default plan, right? So the amount you can ignore because depending on how much you set aside, the amount could be different. Okay, the amount could be different. But what you need to do is, do you want to have like increasing payout? Okay, that is our escalating plan. Meaning you receive lower for start, but every year you receive higher and higher. Okay, that is called escalating plan. Standard plan is you receive more for yourself. You leave lesser behind for your beneficiary. That is called standard plan. Okay, you receive more for yourself, less for your beneficiary. Basic plan, you receive lesser, but you leave more for legacy. Okay, so that's called basic plan. Right. So out of these 3, okay, which is better? Which is the best? All right. It's unknown. Okay, nobody calculate for you. Okay, CPF board give you these 3 options, you have to decide. Okay, so the question is which one is better? There are many factors. Okay, yeah. So before I explain, would you choose, okay, if without going through any explanation, and today you are 55, right? Okay, technically you need to choose only at 65, not 55. Okay, 65, you need to choose how you want to receive a payout. All right, so can I start with the first poll one just to get you to participate? All right. Would you choose which plan would you choose? All right. Which CPF life plan would you choose? Standard, escalating, or basic? Just want to have some I mean some poll from you lah. We have now close to 150 of you. All right, which one will you choose? All right, escalating. I receive lesser now, and I want to receive more because of inflation. I want to receive more in future to support my higher future expenses. All right, or standard. I want to receive more for myself. I don't care how much I leave behind because this is my money. I want to enjoy more for myself. Okay, basic is I don't mind getting lesser. I want to leave more for my family. All right. Uh, yeah. So let me just end the poll. Okay, so it's a quick one. 66% of you choose standard. Okay. So 66% of you can ignore everything I say because if you don't do anything, that will be standard. Okay. Default plan is standard. I would say based on my experience, conversation with my client, right? Most people choose standard. Okay. Because I think most people, when they create CPF long enough during their working life, they should enjoy more themselves. Okay. Unless you say that, hey, I got enough money, I don't mind to take lesser, then you go for basic. Okay. Very few people or lesser percentage choose escalating. Okay. Yeah. So, so that is the outcome. Okay, for the first poll. Okay. I see a few questions, which is good. Okay, keep the question come in. Okay, I'll take time to answer, but let me explain in further first. Okay, because some of the things I could explain in the next few slides. Okay. So which CPF life options do you choose? Standard, escalator, or basic? I've done the detailed analysis. Later on, there's a table to show what is the return. Okay, but if you ask me in summary, okay, just based on the number I've gotten from my analysis, this is a summary. Okay, standard plan is good for those people, all right, who believe that he or she can live beyond 85 years old. Standard plan will give better return. Okay, just make some math. I'm not cursing you to leave early, pass on early or later. It's just based on pure mathematics. Right? I just based on a number that we receive and bequest. All right. Standard plan for those who can live beyond 85. Okay, it's good because you get better return. Basic plan give you highest return if you pass away before 85. Okay. Of course, the unknown is whether you know whether you can pass on before after 85. This one unknown, nobody will know. Okay. But mathematics tell you that if a person live beyond 85, the person will receive more payout from standard plan. Right? Yeah. And of course, if the person live shorter, all right, will actually receive highest total return, not just for yourself, but total return for you and your family. All right. Escalating plan mathematically tell you that it's the lowest return unless you can live beyond 95. Okay, I'm not sure about you. I have no confidence to live beyond 95. All right, that's my view. Okay, yeah. And of course, emotionally or psychology, if you are someone that you cannot manage your saving, then of course you choose escalating plan because you will get more payout in the future to support more expenses in the future. Okay, rather than you spend all the money. Right. So this is a summary based on our analysis. Okay, purely by mathematics. Right. And since the typical lifespan is about 85, that's why if you choose standard plan, more or less you're okay. Right. You are not worse off okay, compared to do other options. Yeah. Yeah. Okay. So that is the plan first. Okay. Now we look at the biggest so-called change. All right. This year. Soon will be last year. Okay, because we are coming to 2026. Right. So this is the budget announced in 2024 and started in early this year, 1st of January. All right. CPF asset account closed for those 85 and above, and you're allowed to park 426,000 maximum. Okay, in RA. Okay, based on this year retirement sum. Okay. So now the question is, should you do that? Right? Should you do that? Okay, so there are three options. There are three scenarios here. Okay, I give you very clear numbers so they have some idea on how this thing looks like. Okay, because it will help me to explain better as well. Okay, so let's assume you have your CPF account is like this at 55. Okay, 200,000 in OA, 426,000 in SA, and of course RA 0 because you just turned age 55. Okay, so that is the first scenario. Okay, where the age you are at 55, this is your CPF balance. Okay, of course, what you can do, okay, by default, okay, CPF board will move minimum sum 213,000 from SA to RA. This is default. Okay, if you don't do anything, you sleep overnight, and then the next day you receive email from CPF board. This is going to happen. Okay, at 55. Okay, if you don't do anything. Okay, yeah. So now option one is if you don't do anything, SA account close, no more. Okay, if SA account close, the balance in SA will move to OA. Okay, become this amount in OA and this amount in RA. Okay, this is if you do nothing, just follow default option. Okay, are you happy or sad with the latest change? You should be sad lah, because last time whatever amount left in SA continue to stay in SA and you get 4% or 4+%. But because of the change in 2025, you won't have any balance in SA. Okay, so what you're supposed to earn at 4% interest rate now become 2.5%. Angry, right? At first I got 4% because of one announcement become 2.5%. Okay, angry, right? I also angry, okay, but can't do anything. Okay, it's a change, right? It's a change. Okay, there's a change here, right? Yeah. So yeah, so that's the default. Okay, and of course some people say, hey, I want to get 4%. I don't want to get 2.5%. When I share this 2.5% in today's context, you will feel that, hey, actually 2.5% not bad, right? Fixed D right now 1%, T-bill less than about 1+%. Okay. If I share this early this year or last year, you'll say 2.5% very low because FD is very high last year, right? Yeah. So long-term interest rate in Singapore is still low. It should be still about 1% or less than 1%. So actually 2.5% is not a bad risk-free return. Okay, it's not a bad risk-free return. Okay. Yeah. Of course, we all want higher return, right? So what are the other options, right? Okay, and you look at it, this 230,000 in RA is getting 4%. This is true. RA is giving you 4% interest. Okay, but the interest stay inside RA account. Okay, you will see your 213,000 in RA go up every year or every month. You can see it's an actual 4% interest rate in RA account, but you cannot withdraw. You cannot withdraw anytime you want. Okay, on paper or in the account, you see the interest go up, your money go up every year at 4%. Okay, you only get the payout through CPF Life. Okay, so you need to understand how you are going to get this payout and what is the return from this plan. Okay, you cannot isolate RA, I get 4%, CPF Life, I get how much percent. I cannot isolate these two. It must view as totality. Okay, you must view it as one plan because this is together. Right. Yeah. So this part I need to go in detail later. Right. But now you need to understand this is a default option. Right. Yeah. So option two, if you say I want 4%, I don't like 2.5. Yes, you still can. All right. Again, by default, CPF board move from SA to RA. Right. And you can tell CPF board say, hey, I don't want to park my balance SA in OA. Okay, I don't want to park here. If I park here, I get 2.5%, which I'm not happy. Okay. Yeah. Then what you can do is you transfer to RA. Okay, to hit the maximum. Okay, called enhanced retirement sum, which is 426,000. Okay. Then yes, you are getting higher interest rate for higher balance in RA, which is 4%. Okay. It seems good. Okay. If you are allowed to withdraw this interest anytime, it's good. Then you are actually getting 4% that you can touch. But the truth is, you get the interest, but you cannot just withdraw freely. Okay, and you have to withdraw through CPF Life. So this is another unknown again. Okay, it's the same unknown. Okay, you need to understand this, and you must look at it as a whole. Okay, cannot say, oh, I got a lot of money in RA, I got 4%, I'm happy. Cannot. You must look at CPF Life as well. okay, on how is the total payout that you are going to receive, right? Yeah. So now, RA 4% or 4.08. I think beginning of this is 4.08. Then after they adjust to 4.04, right? Just stay at 4% RA, okay? Just stay at 4%. Okay. Yeah. So what is the return or interest from CPF Life? Okay, that is the unknown. All right. Okay, so CPF will actually give you this kind of table. In fact, you can actually log in. If you're above 55, you can log into a CPF account. You can actually do the actual projection on how much you will receive from CPF Life. For example, okay, at 55, you set aside 12,000 in RA. Okay, this will grow to 458 at 65. This is clear cut 4% interest. Okay, 55 RA. Okay, 65 RA. Okay, this is clear cut 4%. That's why you can see 12,000 at 55 can grow to 458,000 at 65. This one clear cut. Okay. So when you have this amount at 65, you're going to receive 2,002 to 2,004 a month. Okay, why there is a range? Because it's also based on projected. Okay, it's not guaranteed. Okay, CPF Life also based on projection only. It's not that you sure get this amount. There's still a range. It's still based on projected figure. Okay, yeah. So now the question is, what is the return here, lah? Because you are unable to calculate, right? It's not so clear cut, right? Yeah. So now, I want to ask one more quote before I proceed to show you the answer. Okay, I just want to test your understanding. Okay, so that I know the general public, right, whether you understand the return. Okay, what is the return of CPF Life? RA 4%, OA 2.5, SA 2.5, this one we all know. But how about CPF Life? What is the return rate of CPF Life? Above 4%? Or 4% exactly, or below 4%? All depends on your lifespan. Okay. This is interesting. There are a lot of maths behind, right? Because it's annuity. Okay. There are a lot of calculation. Okay. I did a calculation for you. Don't worry. Okay. I'm not expecting to calculate all this. Okay. But the concept you can understand. Okay. Later on. Right. Okay. Let me end the poll first. Okay. Good. So most of you understand CPF return depending on your lifespan. You are correct. Answer is D. Okay. Actually above 4, below 4 is also correct lah, because it depends on how long you live, right? It could get back less than 4% return. You also can get more than 4% if you live long enough. All right. Yeah. So I don't want to go through all the calculation, but I just want to show you one simple example. Then you will understand. Okay, let's look at this number. At 55, you set aside 205.8 thousand in RA. Okay, don't ask me why this figure, because this is the only example I can get from the online CPF online information. Okay, so you set aside this amount at 55, it becomes 308 at 65. Okay, this is still in RA, not in CPF Life, still in RA. It's clearly 4% return. This one just mathematic. You just calculate, you can get this exactly 4% return. Okay. Now, this will give you this 308 will go into CPF Life and will give you about 1,006 per month projected payout. Not guaranteed, still projected from 65 onwards for as long as you live. Okay. So now the thing is, if you live until 70, okay, what is the total payout you receive for yourself? 5 years, okay, of 1,670 per month times 12. Okay, so you receive 5 years of 1,006 a month. You receive 100,000 payout plus some bequest. Bequest like death payout to your family. Okay, so this one how much? Unknown. Okay, last time CPF board got the actual bequest number. Now no more. I don't know why. I have to calculate by ourselves. But we look at it later. Okay. So look at this scenario. You put 205 at 55. You get back for yourself 100,000. Okay. You get back less than what you put in. Correct? For yourself, plus some bequest, of course. Okay. Total could be higher. Later I can show you. Right. Okay, of course, if you live longer, if you live until 75, you receive 10 years. Okay, that will be 200,000. Technically, break even for yourself, if you don't count your bequest, because to me, like, if you ask me, I park 200,000 in RA, I want to make sure I receive more than 200,000 for myself. Okay. So in this case, technically, you break even for yourself, right? But of course, there will be some return because you will add on in the bequest inside, right? And of course, if you live longer until 80, yes, you get 300,000. This is higher than what you put in. But this is over from 65 to 80. All right. You part 205 at 35. You receive from 65 onwards to 80, which total is 300,000. So what is the total return? Okay. What is the total return or return per year? It's unknown. Okay. Because if you ask me, I need to know so that I can decide whether I should part more in RA or part lesser. Okay. If the return is very low, of course, I want to do something else. Okay. If the return is low, it's very high, I don't mind. Right. So that's why I know. Okay. And of course, if you live longer, okay, then yes, wow, you receive 400,000. Okay. And I can go on. Like if you live until 120 years old, congratulations, you receive probably half a million or more like about $1 million. Right. Yeah. So you see, if you combine our and CPF Life, the total payout to you or to you and or to family and your family is depending on how long you live. Yeah, I think this one we all must agree. Okay, and you should agree because that is the structure of this whole CPF payouts, like to you and to your family. Right? Yeah. So RA will be invested in CPF Life, and the return really depends on how long you live. Okay, this is the structure behind. All right. And I want to Okay, maybe I show one more slide and I'll answer some of the questions in the chat lah. Okay, yeah. So now we need to answer one more question. What is the bequest? How much? If you give 1 million to my family member, of course I don't mind. All right. I don't mind receive lesser. All right. Yeah. So the question is how much? Is there any way to calculate, or is there any way to check this amount? Yes, you can. Unfortunately, it's not shown on CPF website. You have to calculate by yourself. Okay, CPF board do give this formula for us to calculate. Okay, that's why we can calculate for you. Okay, how much is a bequest? Okay, a bit complex because they use the term CPF life premium balance. What is the meaning of CPF life premium balance? All right. But there's a very nice example here, lah. Okay. If you pay a CPF life premium 200,000. Okay, what is CPF life premium? How come suddenly there's premium? Okay, I thought premium referring to insurance. Yes, CPF life technically is an insurance because there's annuity. All right. Yeah. So this amount is the RA at 65. That is called CPF life premium. Okay. Yeah. So assuming your RA account at 65 is 200,000. Okay. And if you receive the payout monthly of 1,000 for 10 months, okay, then CPF board will pay CPF life balance, premium balance, which is 190,000. Okay. So you put in 200,000, okay, at 65. You receive 10 months of 1,000. Your balance is 190,000. And this one will be your bequest. Okay. Then you may be wondering, then no interest. Okay. If I receive for 100 months, okay, I take back 100,000, 100,000 will be my bequest. Then what is my interest? I receive for 100 months. I thought this amount I give to them for the next 10 months or 100 months, they should enjoy some interest, right? How come when I pass on, my family only get back what I put in minus what I take back? Then where does the interest go to? All right? The interest still earn, but go to a pool, not to you directly. Okay, so can you see it? Okay, let me just draw something easier for 65, you put in 200,000. Okay, and you take back yourself, let's say, 1,000 a month. Okay, now you take for maybe 10 months. Okay, yeah, you take back 10,000. Okay, so you give them 200,000, you take back 10,000. Okay, upon that, your family get 190,000. Okay, so in between these, when you're leaving, you're receiving the payout. Actually, there is an interest earned. Okay, for the 200,000 you give to them, there is an interest earned. But interest will not go to you directly, will not go to your family directly. It go to a pool. Okay, CPF Life pool. Okay, yeah. So everyone put together, your money go to this CPF pool. Someone else, whoever participates in CPF Life, all the interest go to this pool. Okay, the interest will go back to you if you live long enough. All right. Once you withdraw all this money, all right, then you're still living. Okay, then CPF Life interest this pool will give to you. Okay, so they can continue to receive for as long as you are living. Understand? So there's a concept of CPF life pooling of your interest and also other people's interest together. Right? Yeah. That's why it depends on how long you live will determine what is our return for this whole structure. Okay, understand? Huh? Okay, I take some time to answer a question because next one is a bit complicated. Huh? Or maybe I just share the next slide. Okay, so now the good thing is when you attend this webinar, you don't have to do all this calculation by yourself. I calculate everything for you. Okay, based on this table. Okay, very complex table. Okay, this is using MIL, FRS. Okay, full retirement sum at 55 years old. Okay, that means someone parked 213,000 in RA at 55. Okay, this example. Okay, other numbers, I do have the calculation, but the concept is the same. Right. So can you see that the payout here? Okay, you can, okay, let me zoom in a bit. Okay, can zoom in good. Right. So you can see this 213,000 I park in, or a person parked in at 55. All right. Yeah. And then the projected money payout based on CPF board is 1,007. Okay, so this person receive 1,007 per month from 65 onward. Because for the as long as the person live, very good, right? If you live long enough, you receive 1,007 forever, right? Yeah. So cumulative monthly payout meaning total the person receive for himself or for himself. Okay, total the person receive. Annualized payout yield, okay, is the return per year to the person. Okay, and you see, hey, how come negative return? Okay, because if I just calculate how much I give to PCPF box versus how much I receive, I actually have negative return because I receive only this amount of money, which is less than the amount I give to them. Of course, my return is negative. Okay, if I don't count the bequest, if I don't count bequest, right? Yeah, so you can see the return, it can be negative or it can be 1-2%. If you just count whatever you receive for yourself. Okay. Yeah, of course, you should not just look at it alone like this, okay, unless you don't care how much you leave to your dependent. Or maybe for you, you don't mind, you don't care how much you leave behind because you have no dependent that need the money, right? Then of course you look at this column. Okay, if you just talk about yourself alone, you look at this column. Okay, analyze payout yield. Okay. Yeah. Of course, to be fair, we also need to look at what is the total payout on death as well. All right. This is the total payout including the bequest. Okay. Yeah. So can you see that the total payout it actually peaks from 65 to around 80 years old. Okay. Why? Because you're actually drawing back what you give to them from 65 onward. Until 80, once you exhausted what you give to them, you start to receive more money from the pool, right? Then the total payout increase again, right? Yeah. So if you just want to look at result, the outcome of CPF Life, total return of CPF Life and the RA, you just refer to last column, right? So you can see the return per year, okay? Initially it's 4% because that's purely RA account interest, okay? But you can see the return start to drop. Okay, because during this period from 65 to around 80 years old, your interest is earned but it's not to use yet. Okay, that's why you can see the return start to drop. Okay, and it start to pick up again because you start to receive the interest from the pool again. Okay, and of course, you live long enough, you could receive 5% return. Okay, because you're receiving more and more interest from the pool. Right. Yeah. So this is to tell you that CPF return depends on how long you live. Okay, it's not just 4%. It could be higher, it could be lower than 4%. All right. Yeah. See, this is based on male. Okay. I have the same calculation for female. Okay. Concept the same, except that female are expected to live longer. Okay. That's why female receive lesser payout with the same amount of money you give to them. Okay, because they expect you to live longer, they cannot give you more per month. All right. Yeah. So again, the same. I mean, calculation is the same. Return with 4%, and then start to drop, and then start to increase again. All right. Yeah. So that is the total return from RA and CPF Life. Okay, it depends on how long you live. All right. I actually wrote an article lah. Okay. I got one article that a lot of people read. And a lot of people start to understand more. All right. And although some people say, you should not look at return, you should look at the total the payout you receive. And to me, I don't understand. I need to know what is my return in order to decide, right, how much I should set aside in the RA. Okay, that's why I calculate this, right, to know what is my option. Okay, what is the return and what is my option. Okay, let me answer your question first. Okay, okay, Grace actually asked, wait, okay, first question first. I keep a question coming. I'll take some time to answer. Okay, I'll cover SRS later. Okay, I'll cover SRS later. Interest rate for CPF Life now, okay, the total number is here. Okay. Can we change the CPF Life payout plan later? I don't think so. Okay, because when you decided, technically they will start to pay you. You cannot halfway say I want to change to basic plan. All right. Or you are in standard plan. Once you start to receive a payout, you should not able to change. Right. Okay, what about an elderly who has the option whether to opt in or opt out for CPF Life? Okay, I think for Grace, you are referring to those older generation kind of scheme. They call retirement sum scheme. Okay, retirement sum scheme is not CPF Life. Technically, retirement sum scheme is just RA account. Whatever interest earned belong to you directly, and you just withdraw. I think for 20 years from 65 to 85. That's all. Okay. If you ask me, I personally prefer that option. Okay. Because whatever interest earned belong to me, easy. Okay, I know I'm getting 4% return for my RA account. I know I'm receiving my own return. Okay. Of course, the downside is if a person leave beyond 85, you have no more money left in the RA. Okay, that's an old scheme, right? Then you need to manage your own cash flow. Okay, so that's the older scheme, right? At 65, you can withdraw 20% RA. Yes, technically can. There's this option. That you can withdraw 20% from RA. Okay, but 80% still have to lock in for the CPF Life. Right. After 55, is it possible to withdraw some money from OA land, then later perform deposit back and withdraw the whole money from OA? Cannot. You cannot suka. I withdraw OA, then you cannot take it as a saving account. Okay, OA, there is some restriction as well. Once you withdraw from OA, you cannot top it up unless you withdraw for your down payment, your housing installment. Okay, then you can top it up. Okay, they call I can't recall the name. Okay, there is a term. You log into CPF, go to home dashboard, housing dashboard. There's an amount that you can top it up back to your OA. Okay, that is to cover back the amount you withdraw for your house. Right. So that option you can top it up. Right. Yeah. If you have that kind of so-called amount that you can top it up, okay. If you never use the OA for housing, you cannot happy go and top up to the OA and take out anytime. Cannot. Right. If your investment, okay, let me see what is the next one. Okay, I'll just look at. I'll show you one more slide. Okay, to show what is the return for each plan. Through different age, lifespan, different payout. All right. Male and female. Male is on top. Female is bottom. Okay, left is including bequest, meaning total, including death payout. Okay, right is just for yourself. Don't care how much you leave behind. Okay, so I just flash it here. You can take a look. Okay, while answering the question, right? If your investment in stock can go at part 55, how is this treated? No problem. You can continue to hold whatever investment you have in OA. You don't have to force to sell. You can continue to hold, no issue. All right. But once you sell, you must hit minimum sum in RA. Okay, in order for you to withdraw the cash from OA. Okay, yeah. CPF Life premium amount depending on plan you choose. Basic different from standard. Of course, yes, James, you're right. CPF Life premium is depending on how much you set aside. It can be BRS, FRS, or ERS. Yeah. Live how long to receive CPF Life interest? Based on mathematics, after 80 years old. Okay, after 80 years old, you start to receive interest from CPF pool. All right. actually very simple to calculate lah. Okay, just calculate total you receive, okay, minus the amount you give to them. Okay, you'll know roughly, all right, after 80, okay, after 80, all right, you receive the interest from the pool. Okay, so the worst age to die, okay, I don't know how to term this, okay, it's at 80 years old. Okay, because at 80 years old, there's a 15 years of interest that you're supposed to earn go to the pool. Okay, all right, and then you pass on this date, okay, 80 years old, then you got a lot of interest in the pool, but you have no chance to receive. All right, so mathematically tell you that there's a worst age that a person pass on that don't receive any interest, right, and contribute a lot of interest to the pool. Right, yeah, so that's for max. All right, yeah, so beyond 80, you start to receive interest from the pool. Where can you read my article? Just Google my name, Louis Gui. You should find the article, or just reach out to advisor that invite to this webinar. We will reach out to you. All right. Yeah. Okay. Is the return from basic plan better than CPF standard plan? You just refer to the numbers here. Okay. Again, depending on how long you live. All right. Different age, different plan, give you different kind of return. Okay. What is the minimum need to set aside in MA? How much increase per year? There's no minimum you need to set aside in MediSave account. There's no minimum, but there is a maximum. Okay, the maximum is, I can't recall this number, maybe 80,000. It will increase every year. Okay, most likely the interest that you earn from MediSave will auto hit the limit. Okay, you don't have to manually go and top up lah. Right? Yeah. Okay. VHR is voluntary. Okay, it's voluntary housing refund. Yeah, that's correct. Thank you. Right. Okay. So there's one more question. It's like we need specific advice on whether elderly should maintain RLS based on actual balance or whether to switch CPF Life. You can contact us. It's a webinar style. Okay, we have 150 of you. I can't give a specific advice. If I give a specific advice, it's not right because I don't know your background, your profile. Okay, I only can give you general advice right now. Okay, if you need more specific advice, reach out to us or the advisor invite to this webinar. Then we can do a holistic wealth planning in order for us to give a better advice. Okay, we should not give advice during webinar. It's not right. All right. Okay, few more Q&A and then I'll move on. Is it true that only a percentage of your RA is diverted to CPF Life if you choose basic plan? Yes, you are right. If you choose basic plan, 10 to 20% of your RA will move into CPF Life. Okay, the rest in RA and you get 4%. You are right. Right. That's why basic plan, actually you have lesser CPF Life allocation. Okay, more is to your own RA. Okay, so that's basic plan. May I know CPF Life annuity amount is projected? Yes. Why CPF Life projected? It's projected because CPF board need to invest on money as well. Okay, so it's a projected figure. Okay, yeah. It's not fixed. It's still projected. All right. If the person die younger, the return of CPF Life can be negative to yourself. Yes. Okay. If the person die younger, the CPF return in the negative to yourself is correct. Okay. But if you include death payout, it should not be negative. Okay. If you include death and your payout to yourself, it should not be negative. Okay. But if you exclude the death payout, then it could be negative. All right. Yeah. Because you only receive few months of payout, and then you put a lot of money at 35, then of course the return is negative. All right. Yeah. So I don't want you to focus too much on the figure here, okay? Because ultimately the return, all this is still very subject to how long you live. Okay, I want to understand the concept of the whole structure, okay, and what are the options out there, okay? Yeah. All right. Okay, I need to move on to the next part. Okay. Yeah. So this is the result. I'll just share the result. Okay. Now you have better understanding on all this. May I ask if today you turn age 55, okay, how much would you set aside in your RA account? Now you have choice and you understand the concept. Hopefully you understand a lot, okay? But if you don't understand a lot, you just reach out to us. Okay. I try my best to explain all this. Okay. So would you choose to set aside VRS, FRS, or ERS? Now you have a choice. Now it's paper exercise. You don't need to do the actual in the CPF. Okay. Yeah. So what will you choose? Uh, okay, let me end the poll. Right. Most of you choose FRS. Okay. Uh, there's no right or wrong. Okay, there's no right or wrong. Okay, my only suggestion for you is if today you intend to put ERS, which means you want to park a lot in RA, do it early. Okay, as best is at 55. Why? Because you can enjoy 10 years of interest from 55 to 65 or 4%. If you contribute all in RA at 55. Okay, you don't wait until like 65, then start to, oh, I want to put a lot into RA. Then no point, because not say no point. It's like you are supposed to earn 4% in RA, but those amount maybe in your OA, right? You get 10 years of 2.5 in your OA, then only top up to ERS at 65, then technically you're losing out the interest, right? So that's probably the better way, like if you really want to do it early, okay, so they can get a high interest for a longer period, all right? Yeah. But do take in mind that bear in mind that all these additional amount you put in is reversible. Okay, once you put in, it's actually locked in. You can't really say that, hey, I want to take out all. Cannot. Okay, it must pay out to you through CPF Life, and the total payout is depending on how long you live. Okay, just be prepared to lock in the money, like if you go for ERS, right? Again, don't anyhow do it by yourself. Okay, talk to someone first. Okay, you can even, I think, make an appointment to CPF board to get them go through with you, or you go through advisor with us. We will probably give you a better scenario kind of analysis. Okay. Okay, I need to answer a few more questions and move on already, because I need to make sure I cover the rest of topics. Right. The next one is what? Wait, best case scenario. Would it make sense to start CPF life payout at 70 so that FRS and ERS have another 5 years to compound? Technically, you're right, but what if the person passed on at 69 and the CPF life payout at 70? That means the person receive $0. Everything go to bequest. So I'm not sure whether it's the best scenario in this case. Okay, yes, you are right to say that yes, the person get a lot of return, 4%, keep compounding a lot. But if the person never enjoy it all, then it's not really best case scenario. Okay. I seldom hear a lot of people want to delay the payout. All right. Unless the person really got a lot of money somewhere else to spend, they don't mind to give more to beneficiary, then they delay the payout to 70. Yeah. Okay, that is based on my view. All right. You mentioned that age 80, then CPF life break even. If I put in ERA and die before it or after 80, well, this one a bit cheap. I don't know what you're asking. If you mentioned that at age 80, okay, then CPF life break even. CPF life break even at 80. No, CPF life never break even at 80. Okay, this one maybe you just text me. Okay, I don't know what you're asking. All right. If you choose ERS at 55, can change to FRS at 65. Cannot unless you pledge property. Then you can withdraw BRS equivalent amount. Can. You can do that. Okay. But you still have to lock in a lot of money there because you only can withdraw BRS equivalent and you have to pledge property. Okay. Yeah. Is CPF life for PR as well? Yes. PR Singaporean, yes. Okay. Unless I think there's a way for you to take out all CPF money and then you never return to Singapore. Can. Okay. But then you have to give up PR lah. Okay. That one you just Google how to do that. Okay. If you don't intend to stay in Singapore forever, then you can do that. Okay. Yeah. 10-year interest go to a pool is not basic plan. Yes, it's CPF life. Okay, not the RA account. Okay. Okay. So I need to move on. If I got time, I come back to your question again. Okay. So now, okay. So why I want to share all this? Because there's one more thing that I also want you to ask yourself. Okay, because this will determine how you should plan your retirement payout. Okay, yeah. So the main objective. Okay, maybe ask. Okay, let me see. Let me stop sharing and okay. Let me ask you one question. Okay, because this will determine how you should plan for retirement. Okay, what is your main objective for retirement planning? Generate enough passive income, generate high return, or preserve your capital. Okay, uh, most people choose enough passive income lah. All right, yeah. Preserve capital, yes, there are some. Okay, generate high return, very few because not say not good. It's just that you may not want to take so much risk when you're at retirement mode. All right. Yeah. So direct passive income, enough passive income. Okay. So there are this kind of framework that we always use. Okay. Which we always share this framework in probably all our retirement webinar. Okay. Essential expenses which are guaranteed expenses you must spend. Okay. Optional, which is like discretionary expenses. Okay. Travel luxury meals, this kind of thing. Those are discretionary expenses. Okay. So when we plan for retirement, we always construct multiple stream of passive income for retirement. Okay, and of course, you cannot ignore CPF Life. CPF Life is still a foundation for retirement planning. Okay, we always start from CPF Life first. Whether you like it or not, it's still your foundation. Okay, it's just that you can decide what kind of option. Okay, yeah. Okay, so that is the foundation. Okay, and of course, second one is the retirement plan or annuity plan. Okay, these two will actually give you a certainty of payout. Okay, certainty of payout support essential expenses. Okay, this one match. All right. Yeah. Then, of course, we have a non-guaranteed income, whether it's bond fund, dividend, stocks, dividend, investment. Those are non-guaranteed return to support your discretionary need. Okay. Yeah. So we always plan according to this framework. All right. Yeah. And then now I want to bring you back to the CPF structure again. Now you have one more option, option 3. Okay, option 1, do nothing, everything go to OA, get 2.5, it's liquid, you can take out anytime by 2.5%. Okay, option 2, you lock more money in RA, you get higher return for the 10 years, 55 to 65, but you're only allowed to take from CPF Life, which is on monthly basis. And that return, it depends on how long you live. Okay, which you can't really do a lot of adjustment. Okay, a lot of money locked there. Okay, but there's also one more option. Option 3. Okay, where you can say that, hey, I don't want to buy in OA, I also don't want to buy in RA. I can do some investment by myself. Okay, yeah. So you can actually put into some form of like annuity, dividend portfolio, or 101 investment plan. All right, that give you some return, of course, with some risk or some no risk. Okay, depending on what kind of instrument you choose. Right, so that will give you more balanced kind of approach. Okay, so this could be another option you can look into. Okay. Also some examples, some concept here. Okay, I'm not asking you to must do this, right? Because there are some options that you want to explore, right? Before you can decide whether to put in OA or RA, right? Yeah. So so RA will go through CPF Life for the payout. If you go into this kind of private annuity plan, right, you can see that actually it can be quite similar to your CPF Life. For example, if someone say, I want to put in 100,000 into private annuity plan, we can actually structure such that you receive a payout from 65. Okay, so this, you can see, we don't talk about number here. We just look at this structure. It can be similar to CPF Life payout. Okay, you receive from 65, for as long as you're living, you receive the same amount, or budgeted amount from 65 onwards. So this structure can be similar to CPF Life. Okay. Of course, there are some flexibility because technically your capital is granted from age 63. Okay, this is one example. Or we can even move this forward. Okay, your capital guarantee in 3 years also can. Your payout start from 3rd year also can. Okay, that means the person at 58 start to receive the payout. Yeah, and then the money you put in at 58 capital becomes guaranteed. Okay, we can structure it in this way because private entity is more flexible. Okay, of course, we have to look at the actual figure. Okay, yeah, but what is the main difference here? Okay, other than the payout amount, all these and whether it's a lock-in early or later, right? Is that your return the death payout is always higher than what you put in. Okay, that means the interest or the return earned belong to you based on this structure, right? Yeah. It's not like you receive the payout, then your death benefit keep dropping. No, the death benefit is always higher than what you put in. Okay, you are drawing from the return, but your capital is guaranteed, all right, after certain years, and their payout is higher than what you put in. All right. So this is something different with CPF Life, because CPF Life, technically this number keep dropping. Right. There's no surrender value technically, because you can't surrender a CPF Life. All right. The death payouts keep dropping because once you start a withdrawal, the BCAFs keep dropping. Right. So that is the main difference between private annuity versus CPF Life. Right. Okay. This one is more like a saving kind of concept. Okay. Of course, you can invest. If you are able to take risks, you can actually invest, as for example, put into some dividend funds, which currently actually perform is quite good because of a lower interest environment, right? You could get like 5-6% kind of payout. Okay, but of course, this one subject to risk. Okay, the amount put in is not guaranteed. It could go up, it could go down. Okay, and there is one more option, which a lot of people actually also reach out to us. Talk about this, the third option. Okay, yeah, so this is a sample of dividend portfolio lah. Okay, you can put in amount, you receive a dividend, right? But it's investment. Okay, this is an investment, right? The other is a 101 investment plan. Okay, the difference between this and the dividend portfolio is you still receive the dividend. For example, you put in 150,000, you receive the dividend. Okay, it can be the same basket of dividend funds, right? Of course, when you receive this amount, the capital you put in will fluctuate because it's investment. It will go up, it can go down, right? But the advantage of going through this kind of 101 investment plan is, you can see over here, the debt payout is 101% of premium invested or account value, whichever is higher. Okay. So if let's say market crash, become 120,000, your investment value become 120,000. Okay. But upon death, your family will still receive 101% of what you put in. Okay. And this is guaranteed. Okay. Or some term this, and this is a capital guaranteed on death kind of investment plan. Okay. You receive dividend for yourself, and at the same time, you preserve your capital upon death. All right. Yeah. So this could be the other option. In fact, it's quite popular right now. Because the newer generation kind of plan, the cost of this plan, it can be quite low as well, because the new generation kind of plan, there's a bonus and a fee, and it's quite low. If you net it over, okay, we have the kind of calculation, right? Yeah. So this is the other option. Instead of going through annuity or normal investment, okay, you can preserve your capital upon death and still receive dividend. All right. Yeah. Okay. Let me touch on a bit on this, how to optimize CPF. Okay. You can reach out to us if you want to understand more about the instrument that I shared earlier, lah. Right. Okay. So what are the things you can do to enhance or to get better return, or optimize our CPF holding? All right. Allocation. Okay. First, of course, CPF SA shielding is gone. Okay, if you never about this, you can ignore. Okay, because you are not able to do CPF SA shielding anymore. Okay, in fact, the change in 2025 is to cover this loophole. All right. And somebody mentioned in the chat, actually, there are still some other loophole, right? That you can make use of the 4%. Okay, but not much, actually pretty much to cover up most of the thing already. All right. Yeah. So this is something that cannot be done anymore. CPF association cannot be done. Right. But you can do a few things. Okay. First is called voluntary contribution. Okay. The other is called retirement sum top-up scheme. And of course, you can do investment using CPF. Right. Yeah. So do note that all these are irreversible action. Okay. Please plan your cash flow properly. All right. If you don't know, reach out to financial advisor before you do any of these, because it's irreversible. Okay. I do all this by myself, and sometimes when I do myself, I also ask myself, hey, should I do this? Okay. I actually plan for myself. Okay. I'm a financial planner. I plan for myself. Okay. And even for myself, when I do all this top up, I also must think carefully because it's irreversible. All right. And I'm a self-employed. There are more things I need to consider, right? Yeah. So you need to make sure you plan properly. Okay. Yeah. So a lot of people confuse about this VC and RSDU. What are the main difference between VC and RSDU? Okay. VC stands for voluntary contribution. Okay. You log into CPF website, you can actually contribute voluntarily. Okay. But there's a limit. $37,740 minus your mandatory contribution. Okay, mandatory contribution is like when you're working or if you're working, you contribute with employee contribution, right? Employee and employer. Okay, that is considered mandatory contribution. Okay, yeah. But so if your mandatory contribution is maximum, okay, you hit $37,740. You can't do this voluntary anymore because you hit the limit, right? Yeah. Allocation you can't decide is based on three accounts: OA, SA, and MA. Okay, or if you're above 55, is OA and MA. Okay, yeah, assuming you have hit a minimum size in RA lah, right? Yeah, it's only OA or MA, or just OA if your MA already hit the ceiling, right? Yeah. So do take note that okay, this will help if you are self-employed like me. If you do voluntary contribution, you are reducing your taxable income. Okay, but if you are working adult, you are employee, you do this voluntary contribution, you cannot enjoy any tax deduction. Okay, you can contribute to increase your CPF balance, but you cannot enjoy any tax deduction. Okay, do take note about this. Right. If you want to save tax, then you do RSDU, retirement sum top up scheme. Right. Yeah. So this one is you top up directly to your RA if you're above 55. Okay, or you are below 55, you top up to SA directly. Okay, provided that your SA amount is less than full retirement sum, or if you're RA, if you are 55 and above, right, you cannot top up if you have more than ERS in your RA balance, right? Yeah, so there is a limit. You cannot be, oh, I got $1 million in my bank account. I want to top up 1 million in SA. Cannot. There is a limit. Okay, and in order to enjoy the tax deduction, you can do 8,000 maximum, okay, for yourself and your spouse. Okay, or you can top up to Medisave account for yourself and spouse. Total maximum you can reduce is 16,000 taxable income. Okay, so this is something that you can do by end of this year. Okay, do take note that there is a 80,000 maximum tax relief for an individual. Okay, so if you hit this limit through other means, okay, most likely happen to those working mother. Okay, because working mother, there's a lot of tax or relief on working mother child relief. Okay, I think 20-30% taxable income is tax relief. Okay, so a lot of working mother, you probably hit the 80,000 maximum tax relief. Even you do this, you will not enjoy more relief. Okay, so check with your IRAS assessment before you do anything. And recently, I encountered one working mother come to me. Hey, how come I'm not in the working mother child relief? And I realized that you need to so-called inform IRAS that you're working mother. Somehow, the IRAS system never capture that the person is working mother. Right? Have to declare to IRAS they're working mother, then only can enjoy the working mother child relief. Right? So that's why year end you should do all this check, okay, to make sure you're safe on income tax. All right? Yeah. And do take note that for RSDU, wherever you top up, eventually will go to RA and go through CPF Life. Okay, it's not that you top up and 55 you can take out, cannot. Whatever you top up is locked, is reserved for CPF Life. Okay, you cannot top up then say, oh, 55 I want to take out all the money I top up, cannot. Okay, because you top up is to increase your retirement sum, which will eventually go through CPF Life. All right. Yeah, and again, that depends on how long you live will determine what is the return, not just 4%. Okay. Mandatory contribution from employer hence can have higher than 40. If you work for more than one employer, can get more than 37,000. I don't think so. I don't think you can have more than $37,740 for your total CPF contribution. Okay. I never encountered that before. All right. The other question is for those who are aged 65 and above, okay, you can check. If you work for two employers, okay, first thing you need to answer to your employer first. I never encountered that. Okay. For those aged 65 and above, voluntary contribution go to RA only. No, still OA, RA and MA. Okay, of course, if you hit the ceiling in RA and you hit minimum retirement sum in RA, it go to OA, right? Yeah. Okay, so that is how you can enhance it. Okay, CPF investment, I don't want to touch too much on this. You can invest, you must open a CPF investment account. Mainly you can invest in Singapore stocks or listed ETF in Singapore or some unit trust for overseas exposure. Right. Okay, so all this I'll just skip lah. Okay. I personally don't prefer to use SA to invest. Okay. Technically, SA only can invest in unit trust. There are still some fund that can outperform 4%. Okay, it's just that I don't want to take the kind of risk just to make extra return. Okay, because 4% is risk free to me lah. Okay, OA if you want to invest can just make sure that over long period of time you are able to outperform 2.5% return. Okay, if not you better don't invest. Right. Yeah, so these are the limit that you can use to invest. Okay, I need to move. I realize I only left about 17 minutes for SRS. Okay, I need to move on first. Okay. Okay. The whole things I share about CPF, it took me more than an hour to share. All right. And honestly, I still got a lot of things I haven't shared. Okay, still got a lot of things that you might have questioned. Okay, the only thing I hope you can do is review your overall financial plan, right, before you decide whether to top up to RA, SA, or do any voluntary contribution. Before you do all this, please do a holistic wealth planning. Okay, because you could probably see, you will probably never see some loophole or not say loophole. You probably never see the whole picture, right? You might want to do holistic planning first, okay, before you take any action for CPF account, right? Okay, so let me move on to SRS, okay, because I only have 16 minutes. Okay, it's until 9 o'clock, right? Yeah, I only have 16 minutes to talk about SRS, right? Okay, SRS is Supplement Retirement Scheme. Okay, I think by now a lot of people should heard about this scheme, lah. All right. But again, it's on the surface. Okay, on the surface, a lot of people know about this SRS, right? There are some factors you need to consider, like, not just about saving tax. Okay, so these are some key pointers that I want to share. Okay, I did a webinar for a company. Okay, we actually provide company talk as well. Okay, so if you're anyone in the company or you're in HR or you're in training department, you can actually invite us to go down to a company to share with your employee. Right, we provide this kind of lunchtime kind of complimentary talk for your company lah. Right, yeah, and last month I did one and I took 1 hour to share this. Right, I'm going to cut short in 10 minutes. All right, focus on key things that you need to know. Of course, SRS, either you or employer can contribute, but I don't think any employer will contribute. So far, I never heard about any employer will do SRS contribution. Right. Maximum can contribute this amount. Okay. If you're a foreigner, you can contribute up to 35,700. All right. You need to open SRS account with DBS, OCBC, UOB. Just go to iBanking to open this SRS account. Okay. That's the first step. Right. And of course, what is the benefit? Okay. If you earn, let's say 100,000, and your usual tax relief, your CPF relief is 31,000. If you do a contribution of about 15.3K into SRS, technically your tax can reduce by about $1,000. Okay, because every dollar you contribute to SRS, you save $1 of taxable income, right? So you could save 1,000 or 1,000 plus depending on your tax bracket, lah, right? So yes, you can enjoy tax deduction if you contribute by end of this year. Okay, don't contribute last day of 2025. Okay, it will take some time to process. Okay, yeah, so do consider this if you want to reduce the tax. Okay, but don't do it now because you need to think through why what are the things you need to know before you contribute. Okay, when you contribute, you save tax, but when you withdraw, you need to pay tax. Okay, but the good thing is when you withdraw, only 50% of amount you withdraw is taxable. Okay, and usually by the time you withdraw, you are usually not working because you're retirement mode. Then likely when you withdraw, you are paying lower income tax. Okay, because based on IRA's tax bracket, if you earn lesser income, you are paying lower tax. Okay, so most likely when you withdraw, although you need to pay tax, you're paying lower tax. Okay, yeah. Unless you withdraw before retirement, then there will be some penalty. Okay, that's why usually once you contribute, it's like more like a lock-in. Okay, you lock in until either 62 or 63. Okay, if you start now, you have to lock in the money until 63. Right. There are some cases you can withdraw early without penalty, but those usually are not a good things, like for example, bankrupt, illness, kind of thing. Okay, so there could be some kind of exceptional cases that you can withdraw before penalty, lah. Okay, without penalty, but that is not a good thing, lah. Right? Yeah. So as you will contribute, you save tax. Well, withdraw, likely you are paying lower income tax. Okay, but you lock it under 62 or 63. Right? Yeah. And what we can do, or what you should do to help you to reduce even lower or pay $0 tax when withdraw, right, is to smooth out your withdrawal for 10 years. Okay. Because for SRS, right, you need to withdraw all the money within 10 years. Okay. Once you start the withdrawal, you must complete the withdrawal within 10 years. Right? Yeah. So in order to pay lower tax during your withdrawal, okay, the best case you should do is you withdraw same amount every year for 10 years. Okay, that means withdraw smaller amount every single year. Okay, and assuming you are 400,000 SRS account, right? Every year withdraw 40,000, 50% is taxable, which is 20,000. But 20,000 is 0% tax. Okay, that's why you don't pay any single cent. It will spread your 400,000 withdrawal in 10 years. Right. So that is why most of the time I try to spread my withdrawal or my club withdrawal throughout the 10 years during the retirement mode. Okay, so they can pay lower income or near to $0 tax. Right. Yeah. So so that is how to optimize your tax or SR withdrawal. Right. Yeah. So now the question is, when you contribute to SRS, you save income tax. The money belongs to you. And the money is locked in until 62 or 63. Okay, you should not keep it either in the bank account. Right? You should invest in something. Okay, because you probably have 10, 20 years to go before you start the withdrawal. Right? So these are the things that you can invest. Okay, stocks, bond, insurance, those without coverage kind of plan, like saving plan, unit trust, EDF. Of course, fixed D T-bill you also can invest, right? Which I don't think any people are interested right now because of low interest rate. Right. Yeah. So these are the things you can invest. Right. So now I want to ask one question. If you have SRS account, may I know, all right, what are you investing right now for SRS account? Okay, what are you investing in with your SRS account? I just want to get some idea, lah. Right. Hmm. Oh, very balanced, quite balanced poll. Okay, what are you investing in with your SRS account? Let me end the poll. Well, I'm surprised to see 20% in T-bill, all right? 40% in funds, 2% holding in cash. You must do something, all right? Unless you are now in retirement mode, then you should probably start to withdraw, all right? Stocks is 41%. Okay. Usually, people attend our webinar doing more active investment or more savvy lah. They should know they need to do something with their SRS money lah. Right? Yeah. But statistic from MAS. Okay. This is the latest statistic based on last year, 2024 December. About 466,000 account holder, $20 billion in SRS account. Okay. And you can see that about 20% is holding in cash. And these people are getting like 0.05% return and locking the money under 62 or 63. All right. That is $4 billion. Okay. $4 billion is sitting in cash. All right. I don't know what they're doing. All right. If you cannot take risk, there are still many other ways to give us better return and don't need to take a lot of risk. Okay. But I don't know why. Okay. Maybe they never look into their all this idling cash. Okay. Unit trust 12%. Insurance 22%. Right. I don't know why fixed D is 0%. There should be some form of maybe not fixed D lah. T-bill, SSB, yes. Fixed D, I don't think there is fixed D. That's why it's 0% here. Okay. Others maybe is referring to some form of like T-bill or something. Okay. Yeah. But share is about 24%. Okay. And these are the age profile lah. Right. And of course, foreigner is 6%, and then the rest 87%, 97%. The outcome total more than 100%. No, 93%. Okay, 93% Singaporean and PR, right? Yeah. So, I mean, these are the national statistic, okay, based on 466 account holders. Right. 466 account holder, okay, given working adults in Singapore, maybe 2 million, okay, that is like 20 to 30% of working adults has SRS account. All right, I think my calculation probably correct. Okay, it's a bit late, so I can't do a lot of mental calculation. Okay, but anyway, a lot of people are having close to 500,000 account in SRS, and 4 billion is sitting in the cash. Right, that's why you should do something, right? You cannot be locked making money and then don't do anything. Okay, yeah. So what are the factors you should consider when you choose what to invest? Okay, if you are doing stock directly, okay, you need to make sure you are active investor. Okay, because you are going to hold the stock until 62, 63, make sure you know what you are doing, especially when it comes to right issue, corporate action. Okay, and I don't prefer to invest in REITs using SRS money, okay, because a lot of time REITs, when they want to acquire new property, they have this kind of right issue. Okay, right issue meaning they want to raise money to buy more property, right, to generate more income, okay, which is a good thing, it's a good thing, right? But because of right issue, you need to use SRS money to subscribe the right issue. Okay, if not, your holding will be diluted. Okay, this is a corporate action kind of terminology, right? But if you don't have sufficient balance in SRS account, in terms of balance cash in SRS account, you are unable to subscribe. Okay, so technically your holding can be diluted. Okay, that's why if you ask me, I don't prefer to buy stock directly using SRS because a lot of restriction here and there, right? And focus on total gain. Okay, I know a lot of people like dividend. Okay, but if you invest in SRS money, you don't have to specifically choose those dividend stocks or dividend funds. Okay, because those dividend received will go to your SRS account. And sitting idling cash in the SRS account is not good because you're getting like 0.05% kind of return, right? So you don't purposely choose dividend fund or dividend stocks. Just look at total return when you invest your SRS money. Okay, yeah. Right. And I prefer global exposure, okay. You don't, I mean, since you are investing for long term, might as well invest globally. Don't just buy like Singapore stocks alone. I know Singapore stocks are doing well this year, okay, but I try to diversify as much as possible. Okay. Yeah. And do bear in mind that because all your return, whether it's capital gain or dividend, will go back to your SRS account. Okay, and remember when we withdraw from SRS account, it's taxable, even if it's 50%. Okay, so in other words, all the gain, right, SRS account count gain, it could be taxable when we withdraw. Okay, and because of this, right, if you look at total portfolio point of view, maybe you can consider, because high risk, high return, okay, those, if you use cash to invest, you may want to go for high risk, high return, so that you make a lot of gain, you don't have to pay any tax. Okay, then your SRS, maybe you want to a little bit more conservative because you won't want to do every investment also high risk, right? Yeah, maybe you can consider like SRS doing some medium or balanced kind of risk, or even some low risk, so that you don't need to pay a lot of tax, okay, when you withdraw. Okay, so that is from the total portfolio point of view that you can consider, right? Yeah. And of course, plan withdrawal, try to spread the withdrawal evenly to minimize the taxable amount when we withdraw. All right. Yeah. So how to optimize yeah, so what is this? Okay, yeah. So withdraw evenly. Okay. This is just one example. I don't want to go through calculation with you. Okay, just to look at the red color numbers here. If you do a lump sum withdrawal, technically you're paying a lot of tax. Okay, if you spread the withdrawal for 10 years, you're paying much lower tax. Okay, this is just to illustrate based on actual calculation, right? Yeah. Yeah, so that is how you optimize tax or when withdraw, spread evenly. Okay, when withdraw. So what we usually do, this is one of the convenient way I would say, right, to stack up multiple SRS annuity. Okay, for example, a person consumed 15,300 at 35 years old, you put a lump sum into annuity plan. You can call it annuity, you can call it retirement plan. It's just a payout structure for 10 years. All right. Yeah. So why 10 years? Because it's aligned with the SRS withdrawal period, 10 years. Okay, 62 to 71 or 63 to 72. Right. Yeah. So do a plan like this. Okay. And then every year, do the same plan. Okay. 36, also do the same plan, set the same payout period. Same 62 to 71 or 63 to 72. Okay. Just set up all the plan into with the same payout period. Okay. Yeah. So when you do this, what you are doing is you spread up your withdrawal within the exact same years, 10 years that you want to withdraw for SRS. Okay. Technically, you're smoothing out your withdrawal. Okay. You don't have to decide, hey, this year I need to withdraw how much, this year I need to transfer how much stocks. You don't have to, because this kind of plan can spread out the payout to you. Right. And if you structure it nicely, these are capital guaranteed plan. Okay. Of course, you don't terminate early, lah. Okay. So technically, you can preserve your capital as well if you do this kind of plan, right, for your SRS money. Right. Again, this is considered low risk, right? High risk can use cash to invest so that your total portfolio allocation is more balanced. Right. And of course, you can invest. Okay. We do a lot of this kind of model portfolio. Okay, using core satellite approach, right, where we allocate into global exposure with some tactical allocation. Okay, this is more into investment. Okay, I just share the concept. Okay, I won't go through details. Right, global exposure. Okay, global bond, global equity, and some tactical allocation. For example, Asia equity, China equity, which is still undervalued. Okay, or fairly valued at the moment as compared to US equity. Right, so we invest using SRS to have the kind of global exposure. Right. Yeah. So this is a model portfolio, right? And some of the clients actually follow this, and they invest every year. They top up 15,300. They top up into this model portfolio that we have, right? Yeah. So I would say high single-digit return is possible because we are doing global equity kind of exposure, right? Or global diversified kind of exposure, right? Yeah. So there are people do this, right? And we help them to invest. Oh. Okay, this one I'll skip because yeah, in due time I'll just skip that. Right. So anyway, for it come to SRS, it's the same concept. It's a supplement scheme for retirement. Okay, so the same 4 layer apply as well. Okay, and the layer 2, 3, 4, you are able to use SRS to invest. Okay, that's why you can use it as a supplement, right, on top of your CPF Life. Yeah. Okay, so again, I want to advocate about holistic wealth planning. Okay, I run through very fast when I share SRS or even CPF. I also rush through a bit. Because we are zooming further, there's a lot of questions that I cannot answer unless I know your profile, right? So today, when you attend this session, okay, is to give you a good idea of how SRS and CPF works. Okay, ultimately, you need to look at your financial plan. Okay, you need to plan properly such that all these fit into your overall financial plan. Right? Yeah. So as a team, holistic wealth planner, we all advocate on holistic wealth planning. Right. We even have our holistic wealth reports. Okay, now we have version 3.0. Okay, we just upgraded to version 3.0. Right. You will see that we have a very complete holistic wealth reports that you can use it. Okay, we will use it to do holistic wealth planning for you. Okay, so you will get this kind of report card or like medical reports for you. Okay, yeah. So probably I'll just show you quickly. Yeah. So we have a very nice template that we have created for you. Right. What you need to do is just reach out to the advisor, invite you to this webinar. Right. So we have this 3.0. Okay, so you can see that depending on what you are looking at, I mean, we can do a holistic reports from income statement, balance sheet, okay, your insurance summary, insurance coverage, investment allocation, projected investment, your financial ratio, of course, or even a retirement projection. Okay, the 4 layer. Okay, we do exactly same what we present. Okay, in a very systematic way. All right, then you will get a report from us. Okay, so these are our reports. Right, you can print all these pages for you. Right. Yeah. So we put it very nicely in a very nice report. Yeah. Including all the so-called concept. Yeah. So this is what we do. Right, to help you to do holistic wealth planning. Right. If you want, just reach out to us through scanning this QR code. Okay, if not, just Google our name, HWP, or reach out to advisor that invite to this webinar. Then we will do holistic planning for you, inclusive of how you can plan for your CPF and SRS. All right. That's all for our sharing. Okay, I hope you learned a lot throughout this session. Yeah. And anyway, it's year end. Okay. I probably won't see you until next year. Okay, because this is our last webinar of the year. And I wish you happy holidays. Okay, it's a holiday season. All right. And I'll see you next year again. All right. For our future events. All right. See you. Bye bye.